Stop what you are doing right now, because what the IRS just confirmed for 2026 could put real money back in your pocket. And millions of seniors and retirees across this country have absolutely no idea this is happening. We're talking about expanded tax benefits, higher deductions, updated retirement rules, and changes to how your Social Security income is treated, all confirmed for the 2026 filing year. The people who benefit the most from these changes are often the last ones to hear about them. That changes today. If you are 65 or older, if you are retired or getting close to it, if you receive Social Security, a pension, or money from an IRA or 401k, then the next several minutes of your life could be worth thousands of dollars. The IRS has officially confirmed that the standard deduction for seniors age 65 and older is increasing again for the 2026 tax year. Now, if you've been filing your own taxes for years, you already know that the standard deduction is one of the most powerful tools available to everyday Americans. It's the amount the government lets you subtract from your income before calculating how much tax you owe. The bigger it is, the less you pay. And for 2026, that number is going up in a meaningful way. For a single filer who is 65 or older, the enhanced standard deduction, which is the regular deduction plus the additional amount the IRS gives specifically to seniors, is now reaching a level that could eliminate or dramatically reduce your federal tax bill entirely. For married couples where both spouses are 65 or older, the combined deduction gets even more powerful. The IRS has also updated the income thresholds for determining how much of your Social Security benefit is subject to federal income tax. This is a massive deal, and I want you to really hear this. Not everyone knows that your Social Security benefits can be taxed, up to 85% of them, in fact, depending on your total income. But what many people don't realize is that there are very specific income limits that determine whether you're taxed at 0%, 50%, or 85% of your benefits. And for 2026, those income thresholds have been updated. That means some of you who were previously getting a portion of your Social Security taxed may now fall below the threshold, which means a portion of that income could become tax-free for you this year. If you receive $1,800 a month in Social Security, that's $21,600 a year. If even 50% of that was previously being taxed and now it isn't, you're looking at savings that could be in the hundreds or even thousands of dollars depending on your tax bracket. For 2026, the IRS has confirmed new rules around required minimum distributions, or RMDs, from traditional IRAs and 401k plans. If you don't know what an RMD is, here's the quick version. Once you reach a certain age, the IRS requires you to withdraw a minimum amount from your tax-deferred retirement accounts every year, and you have to pay taxes on that withdrawal. For many years, the age at which RMDs kicked in was 70 and a half. Then it moved to 72, then to 73. And for those of you born after a certain year, the new rules push the starting age even further, giving your retirement savings more time to grow before the government starts requiring you to take money out. But here's the critical thing about RMDs that trips people up every single year. If you miss your required minimum distribution, the IRS can hit you with an enormous penalty. And for years, it was 50% of the amount you failed to withdraw. Recent legislation reduced that penalty to 25%, and in some cases, even 10% if you correct the mistake quickly. But that is still a penalty you absolutely do not want to pay. So if you or someone you love has money sitting in a traditional IRA or a 401k, you need to make sure you understand the new RMD ages, the new deadlines, and the steps you need to take this year to stay in compliance. Now, before I go any further, I want to quickly ask, if you're finding this information helpful, if you feel like this is the kind of update you want to keep receiving, please take just 2 seconds and hit that like button right now and subscribe to this channel. We put out clear, simple, honest financial information specifically for seniors and retirees every single week. No confusing language, no hidden agendas, just the facts you need to protect your money and your future. Subscribing is completely free, and it means you'll be notified the moment we release the next update. And trust me, there are more important changes coming this year that you are going to want to know about. So hit subscribe and let's keep going, because we are just getting to the good part. The IRS has also expanded and clarified the rules around the credit for the elderly or disabled. a tax credit that a shocking number of qualified seniors simply never claim, either because they don't know it exists or because they assume they don't qualify. This is not a deduction. This is a credit, and the difference matters enormously. A deduction reduces the income you're taxed on. A credit reduces your actual tax bill, dollar for dollar. So if you owe $800 in taxes and you qualify for a $600 credit, you now only owe $200. The credit for the elderly or disabled is available to people who are 65 or older, or who are under 65, but retired due to a permanent disability. There are income limits involved, and the credit phases out as your income rises. Let's also talk about medical expenses, because this is an area where senior filers have a significant advantage that many people underestimate. The IRS allows you to deduct qualifying medical expenses that exceed a certain percentage of your adjusted gross income. For many seniors, medical expenses are substantial. Doctor visits, prescription medications, hearing aids, dental work, vision care, long-term care premiums, and more. And for 2026, the rules around what qualifies as a deductible medical expense have been clarified in ways that are favourable to seniors. For example, certain costs related to in-home care, transportation to medical appointments, and even modifications made to your home for medical reasons, such as installing grab bars or a wheelchair ramp, can potentially be deducted. Let's say you are 67 years old, retired, and your income for the year comes from 3 sources: Social Security benefits of $22,000, a small pension of $12,000, and withdrawals from your IRA of $8,000. Your total income for the year is $42,000. Under the rules that are in place for 2026, your combined income for purposes of determining Social Security taxation would be calculated using a specific formula. And depending on your filing status and that calculation, you might find that only a portion of your Social Security benefit is subject to federal tax. Then, after applying the enhanced standard deduction for someone aged 65 and older, you could potentially reduce your taxable income dramatically. Add in the credit for the elderly if you qualify, and suddenly your federal tax bill looks very different from what you might have expected. The tax code has real benefits built in for people in your situation, but you have to know about them to use them. The IRS has updated the rules and contribution limits around IRAs for the 2026 tax year. And there's something called a catch-up contribution that is particularly important for people over 50. If you are 50 or older and you have earned income, meaning you're doing some kind of work, even part-time, you are allowed to contribute more to an IRA than younger workers. For 2026, those catch-up contribution limits have been adjusted. What this means in practical terms is that if you're still working in any capacity, you may be able to shelter more of your income from taxes by putting it into a retirement account. This is a strategy that many financial advisors recommend to clients who are in their 60s and still bringing in some income. It reduces your taxable income now and lets that money continue to grow. And here's something that surprises a lot of people. Even if you have a 401k at work, you may also be eligible to contribute to a traditional or Roth IRA on top of that, depending on your income. If you found this video valuable, if it opened your eyes to something you didn't know before, please subscribe right now so you never miss another update like this one. Hit the notification bell so you'll be alerted the moment we post something new. And if you know someone, a parent, a sibling, a neighbour, a friend who is retired or approaching retirement and could benefit from this information, please share this video with them today. Because knowledge is the most powerful financial tool there is, and it shouldn't just belong to the people who can afford expensive accountants and financial advisors. It should belong to everyone. Stay informed, stay protected, and we'll